What are crude oil futures options? Have you ever wondered how traders manage to profit from the fluctuating prices of crude oil without actually buying the physical commodity? Let's break down the concept of crude oil futures options. Crude oil futures options are financial instruments that give traders the right, but not the obligation, to buy or sell crude oil futures contracts at a specified price before a certain date. This means you can participate in the oil market without owning the oil itself. To understand this better, let's first look at what a futures contract is. A futures contract is an agreement to buy or sell a specific amount of crude oil at a predetermined price on a future date. Crude oil futures options are essentially options on these futures contracts. When you trade these options, you are trading the right to buy or sell a futures contract, not the actual crude oil. There are two main types of crude oil futures options: call options and put options. A call option gives you the right to buy a crude oil futures contract at a set price, while a put option gives you the right to sell a crude oil futures contract at a set price. Traders use these options for different reasons. Hedgers, such as oil producers, use them to manage risk and lock in prices. On the other hand, speculators aim to profit from price movements in the oil market. These options are traded on major exchanges like the New York Mercantile Exchange, the Intercontinental Exchange, and the CME Group. The underlying asset for these options is the crude oil futures contract. In the United States, the most commonly traded crude oil futures contract is the West Texas Intermediate contract. When comparing crude oil futures options to stock options, there are some similarities and differences. Stock options are based on shares of a company, while crude oil futures options are based on futures contracts for a commodity. Both types of options allow traders to use strategies like buying calls or puts, spreads, and straddles. However, crude oil futures options tend to be more volatile and can be influenced by various factors, such as geopolitical events, changes in supply and demand, and global economic trends. If you are interested in trading crude oil futures options, you will need access to a futures trading platform. It is essential to understand how futures and options markets operate. Traders should be aware of contract specifications, such as the size of the contract, which is often 1,000 barrels for standard West Texas Intermediate futures. You should also know the minimum price movement and the expiration date of the options. Options on these futures contracts can be exercised before expiration, which is known as American style, or only at expiration, known as European style. Understanding these details will help you navigate the trading process more effectively. In summary, crude oil futures options provide a way for traders to engage in the oil market by trading options on futures contracts. They offer flexibility and opportunities for both risk management and speculation, making them an attractive choice for those familiar with stock options and looking to expand into commodity markets.